We have a growing group of private investors that are definitely deploying capital, and they are not just impact curious. They are impact allocators.
Welcome back, everybody. Richard Brubaker, founder of Collective Responsibility, here today with another episode of the Mission Driven Podcast. Through this podcast, I'm speaking with the spectrum of mission-driven entrepreneurs, investors, academics, and the wider ecosystem about what it takes to deploy entrepreneurship and innovation against the challenge that we're seeing outside of our window. And so in this episode, I'm extremely excited to be joined by Katy Yung, who's the co-founder and CEO of the Hong Kong-based Sustainable Finance Initiative. Katy spent more than 15 years in the space and impact investment, and over the last 5 years been building the SFI community with a vision for a world where sustainability is synonymous with finance. And so with that, Katy, thank you very much for taking the time to join us.
Thanks for having me, Richard.
Welcome to the show. It'd be great to have you start off with a personal introduction and tell us about the mission that you're on.
Sure. So I am Katy Yung, and I'm based in Hong Kong. So a bit about my background. I started my career in investment banking. Then I transitioned to work for a family office managing their portfolio that was 100% aligned to sustainability and impact. And so today I am leading SFI, Sustainable Finance Initiative. And essentially what we're doing is building a community that is catalyzing private asset owners towards capital deployment in sustainable and impact investing.
Now, you've been in the space a while. You work with Annie over at RS. I mean, you're one of the original people that was in the space 15 years ago. Just a bit of a background. What is the community like? How has it changed over the last 15 years? And what are you trying to do differently through SFI?
I remember when we just got started at RS Group, we were literally, huddled around a boardroom, doing investor circle brown bag lunches with, 10, 12 people, whoever wants to come, whoever's interested enough. And so fast forward to today, at SFI alone, we have built a network of, around 70 to 80 family offices and, next gen and high net worth individuals, basically investors who are already deploying capital towards impact or they're impact curious.
How much of what you're seeing now is curious and how much of it is actually they're deploying money and they found their path?
I would say that right now we have a growing group of, private investors that are definitely deploying capital and they are not just impact curious. They are impact allocators. And they range from doing opportunistic investing to, having dedicated impact ESG portfolios to ones that are, walking the talk and doing a total portfolio approach. Having said that, there's still so much room to build the tent. There's a lot of private wealth in the region. So a lot of our work is really converting the impact curious to, the impact doers and become, active allocators.
What is the size of the tent when it comes to the greater picture in Asia? What's the role or the uniqueness of family offices and private wealth within that space? Like, are they the majority of the space? Are they just a small percentage? What's their role right now?
Private family offices are uniquely positioned to do certain things within that capital stress stack. So they could take on more risks. They have a longer time frame in terms of the capital that they can deploy. And there's a lot of talk about catalytic capital and blended finance structures. So when we look across the different topics, actually, I think private investors play a unique role of catalyzing the space when they need to seed, say, first-time fund managers, support local ventures. We've done a few through SFI. That are in the environmental space and bring them up to speed so that these technology solutions are scalable. Last but not least, very unique to family offices is we often say that they're sitting in this nexus of running a family business, which is, has operational and supply chain implications. They have a sort of investment capital part within the family office. They also are usually, have an active philanthropic arm. So they have a family foundation that give off grants. So this flexibility and fluidity across these three parts would mean that they can play nimbly across the capital spectrum.
I want to hear a little about how you see Asia Pacific comparing to other regions. And, there's been obviously the last 20 years, 25 years of this region has been kind of this explosion of wealth as well as responsibility. I think, and the family offices handing over to the next generation. So there's like the speed of momentum here, but I'm wondering, how are we doing it in this region? Are the families ahead, even, behind, say, their European counterparts? And is there something unique that you see in Asia that gives you hope that actually you're going to see like a lot of leading models coming out of here?
In Asia, I think, first of all, it's consisted of so many different countries. And I've come to learn that depending on which country you are, the incentives would look very different. I would say that I'm also changing my mindset to not think about it in this lens that we're behind, we need to catch up. Simply because at this stage, in terms of economic development, in terms of demographic structures, and where we need to shift in terms of climate, everything, we're kind of looking at a different problem set, if you will. So I'd like to think that it's not catching up, it's coming up with our pathways to achieve impact, achieve net zero, whichever topics that matter. We found that I think climate change is definitely an overarching lens that a lot of the families that, is in SFI community look at. So it's not just pinning it into we're about green tech or climate tech. It's using climate because it's a risk and an opportunity as a lens across any of the sectors that you're looking into. So I think I'd like to think that we have a potential because of the three bubbles that we're talking about is very closely aligned, and we have a lot of family-owned businesses here in Asia.
Okay, so from there, I want to bring in your transformational wealth report that you released about a month ago. Talk to me about the report itself. What was the mission? What were some of the findings you were looking to have, and what were some significant findings from the report itself?
So maybe the genesis of why we did this is we did it at the back of our annual SFI Impact Summit, which we host once a year. We have the privilege of having a lot of the wealth owners and the principals in the audience. So we thought, why not do a live pulse check? The survey came about this way. Some of the interesting findings, I would say that, we mentioned about 5-10 years ago, there was a lot of opportunistic investing across the board. What we were kind of surprised to find out is, structurally speaking, right? There was actually 17% of the group that is using dedicated impact and ESG sort of carve out portfolios. So that to us shows that there's a maturity in terms of, the ways that, impact investing is being thought of. The second thing that was interesting is 62% of the respondents felt that their impact investments met or overperformed the financial return targets. So this really shows that it can be a viable investing style that is, counter to a lot of, I suppose, still a lot of the prevailing preconceived notions that this is a below market return investing style.
How much is being, say, primary market, they're investing directly into companies or into organizations, and how much of it is actually they're just creating a portfolio that's on the market, main boards, listed companies, but just applying an ESG filter to create something better?
So we found that the top three asset classes are precisely what you've mentioned. It's a mix of the top three. The first one is in venture capital and private equity. The second is going into direct investments and into ventures. And then the third one is public equities. And then there's 15% in blended finance. So it's really across the board.
Because 15 years ago, it was just, we're trying to do direct, we're trying to do VC, we can't find anything. So we're just going to do public, and we're going to put it into like Unilever and a few other brands that are well known. What's changed? Like, is it that there's more deals and more mature and entrepreneurs? Is it that there's better platforms, or is it that they've just gotten smarter, a wiser palate to figure out like what's a good investment directly?
I do think primarily it's almost a growth in the pipeline of the types of deals that's not limited to, it's just direct deals and then, the Unilevers of the world. So in the past 5-10 years, we've seen so much more types of, funds, direct opportunities, and even in the public equity space, despite the ESG backlash, right? previous to that, there are more funds that are classified SFDR 8 and 9 that are, can be considered impact. So a lot more opportunities. I do think on the investor side, they're also thinking about it more holistically. So rather than just zoom in and assume that I can only do direct venture investments to express impact in my capital, they're really starting to build it out from a multi-asset class approach. And that's where we see not just in the venture space, but direct and public equity, blended finance, and actually also emerging is private debt and public debt as well.
What are the main drivers for family offices doing all this now? It really is like there's so many different things happening. It seems to me that you're seeing a reflection of maturing practice. They're investing more directly. They're investing into larger offices. They're allocating more capital. What's driving this?
I think overarching, of course, again, it depends on the family. Some do it from a let's do no harm perspective. Some of it do it because, our company is getting all these, stock exchanges asking us to comply, and we see climate risk coming through from a risk lens. But from the next generation, I think there's also with them being way more attuned to sustainability and climate change, they generally want to find a pathway where they creating financial return and also finding impact. So the drivers are multifold, I would say, which makes it more interesting. In the past, it might be just, risk mitigation. And now it's finding opportunity, and now it's like both, either or. So not either or, but both. So this also, with our survey, we also mentioned, what are the primary drivers of impact investing across the family? So the top three, they want to contribute to sustainable development, they want to maximize impact, and they want to generate financial returns.
Yeah. But those top three, I mean, that's get your cake, eat it too, and repeat the process. It's very difficult. So what's the reality when it comes to those three things? It's like, is there one of those that's really actually gaining business value traction where they can keep betting on that? Like, it just makes good sense, makes good money, versus when we want to contribute to sustainable development. That's a very high level thing. Like, is that something sustainable that you can keep spending money on, or does it eventually have to go to number two, number three, where you see an actual return? Like, how many families are actually able to find that balance, and is profitability core to their maintenance of wanting to contribute to sustainable development?
This is a really generic broad stroke, but from what I'm observing, the families with, listed companies and operations, they are getting into that proof of concept where we want it core to the business. We want this to make us money. We want this to be the business model. Having said that, it's been tough times, right? And we look at the economy around us, right? The geopolitics and the interest rates. So we're working across a sort of a wintry type of climate, but I do think we will see through to it because we're seeing some green shoots on the operational side. Real estate families, manufacturing companies going beyond the let's check the box and do the reporting, invest into some solutions. How do we then dial up the needle into greening the supply chain, investing in some technology solutions, pivoting our services? And same with the family investment side of things, right? They're also going beyond, let's put our money in a few direct VC ventures and what comes through. They are looking into, let's put it in a few funds, right? So it's diversification, it's actual portfolio, sort of asset class diversification. And so they're growing attempts to make it more robust and aligned with their total portfolio investment policy statement. So check back maybe in 2 or 3 years when the cycles come through, whether we're kind of seeing these drivers, going past the broad strokes, but saying this is at the core of what we do in running the business and making investments that we must embed impact and ESG considerations.
They got risk, they have diversification, they have allocation. How much of their, say, total portfolio are they putting towards this right now? And is it a growing percentage, or do you find that people are just a little bit more risk averse these days and they're a little bit more cautious in their steps? Like, because I feel like there's counterbalancing forces here. One is that You have the next gen coming in saying, look, we need to change direction of the family business, let's do more. But then, the top level, the parents are still like, look, it's a bad time. We're allocating as we can. Like, what's that dynamic there? Like, is it a large percentage that's being allocated? Is it a larger percentage and growing? Like, what do you find there?
The relevant statistics is in the survey, 26%. So a quarter, right? Over a quarter of them have at least half of their portfolios in impact and ESG. Is it growing? I think, it depends on whether you're tracking it, in what time frame. I do think what we're trying to say is these cycles, and let's step, when it's risk off, understandably, I think there will be some tactical plays there. So that's why I think it's really important to embed these ESG and impact principles into investment policy statements. So it's embedded in the governance. And so it doesn't matter that of these fluctuations, but at least you're sticking to bandwidth, and it's a long-term kind of strategy and approach. That's what we're trying to get to, I think, with the families at this stage.
And in that aspect, how important are the younger members of the family or the next gen or the next gen as part of that embedding, calcifying, and moving forward?
Very, very important. I think, there's a lot of prevailing assumption that, oh, this is just a next gen thing, it's risky. No, what we're seeing is actually we're noticing behind the scenes very productive and measured conversations that are intergenerational. Because next gen, they also have a lot to bring to the table in terms of awareness and understanding about sustainability, while learning the ropes of traditional asset allocation and sort of how do you make investments. And so again, this is interesting because we did poll the audience around where you at in terms of next generation and the former generation in terms of how to run the business, how to make investments. What we see is like the critical need right now is that last mile consensus that is needed, because 64% of them, when we ask what are the intergeneration perceptions of impact, is they feel like some of the members still require persuasion, but they recognize the value of considering impact alongside financial returns. So this has already moved on. It's not like they are allergic to this idea or think it's against financial return. It's 64% of think they're on board. They just need this extra last mile convincing to get over the board.
What would convince them?
That's a big question. I think in the past, we used to think this is a very scientific, logical, but if we all know mindset change, behavioral change, right? You need multiple, multi-pronged ways to get people to shift. What needs to come through more, I think, from an Asian context is peer-to-peer sharing. That's how families learn and change from each other. So-and-so, I see they're doing this. But at the same time, I think there's culturally, sometimes we're a little bit more reserved for certain, I'm also very generically speaking that, because not all families are like that. They want to do more behind the scenes before they come out and share. But to change, we need peer-to-peer, a lot more peer-to-peer sharing, exchanges, and case studies. Obviously, policy also comes into play, I would think. In a lot of markets, the government is stepping in terms of promoting it, incentivizing it, defining it. So I think we need all these for these changes to happen.
What about quality of deals? Is there enough deals right now? Or do they just feel overwhelmed? Like there's so many climate tech, so many, nature-based solutions. Like they just don't know how to assess a deal anymore. I'm curious, because there's been so much coming out on that side. I'm wondering, money's money, right? Like if there's good quality deals, they should be deploying. So what is it about that side?
So I personally think that we're against people's priorities and time, and it's also very fragmented and overwhelming to pick and choose from all these, unless you have a dedicated team in-house to be sourcing, vetting of this all day long. What is missing is sometimes easier on-ramp solutions for investors to deploy.
And that's kind of what the banks have been doing for years, right? Like they've been creating these funds of funds, and they'll take your money through the high net worth office and they'll start to deploy it in there. But outside of that, who are the main aggregators or platforms that you're seeing and that are trusted here? And then if you deploy against that, does that make it harder as an entrepreneur to raise money? Because you're like, no, I'm already working with this group and you need to kind of get on board with them. Otherwise, we can't work with you.
There's a whole space where there are smaller funds, which just simply can never get on a bank's platform. So, we need different pockets of solution. There's a wonderful report that was released by GSG Impact that talks about all the regional wholesale funds in Asia Pacific and beyond. So those tend to be, I think, curated depending on different countries. Sometimes it's the social impact sort of association and organizations that are structuring these opportunities. Sometimes it's banks coming together. Sometimes it's investors coming together. From the entrepreneur's perspective, we're getting actually different types of feedback because we did think about this fund of fund structure and interviewed or spoke with some, I'd say, GPs and entrepreneurs. Actually, this would solve their problem a little bit because to fundraise from family office and individuals, it takes an awful lot of time to curate. And so unless you're so ginormous that you're monopolizing the market, I think having one slither of this solution actually really helps them from the fundraising perspective.
So then what do you think is the opportunity that you kind of came away from this report? Like, is this a good opportunity for SFI? Is it an opportunity for a new platform to come in? Like, what opportunities did you see through this that can help bridge some of these gaps that exist?
Let's say on the community side, we're definitely getting a strong sense that the impact curious has moved along. So the opportunity for us is really finding ways to engage with these family offices. Some are doing opportunistic investing, some may not be ready to deploy. So how, from SFI's perspective, how can we add value and get them into the tent and give them an easy on-ramp to be part of the community and at some point get ready to deploy. So with that, we already have the existing solutions. We've got digitalized courses, we've got events, learning by doing, site visits, meet the experts, and then we've got Investor Circle. In terms of the opportunity, what we covered, I think we've always had in mind some structured solutions to curate the existing funds that are already in the market. Can we structure something like a wholesale fund and a fund of funds? That's one opportunity. The second piece is, I think there's a learning by doing opportunity. There's a lot of talk around blended finance and nature-based solutions. Worth wondering whether with the Asian families and the foundations in the philanthropic arm, there seems to be emerging interest around them on the topic of climate philanthropy. And can we edge that further into climate blended finance? And so we're toying with the idea of curating a program where we kind of bring these constituents up to speed.
I was just thinking more broadly, like you're focusing on climate and nature-based solutions, very hot topic right now. But there's many other issues like poverty alleviation and education and others that have had longer traction. And I'm curious, how are you building your capacity to kind of serve the issue-based knowledge or the issue-based interest? Like, you just pick one a year? Like, I think it's something that a lot of people struggle with. Like, how are you guys managing it? And then
I think if we were running a fund, if we were fund managers, then we would have to be very clinical about picking like 2 or 3 thematics that we just have to zone in on. But because of SFI, we're more of a platform. So I don't think we can be way too focused and just pick one. But we also, pragmatically speaking, we have limited time and resources and capacity. So we're kind of somewhat in between. And the way we shortcut that is we poll our members in the form of a survey. What topics, what thematics, top 3 are you interested in? And then we work with the common denominator. And every year we do a refresh to also tweak the themes. So as of late, I think topics like food and agriculture, more like on the upstream side of things, circularity and healthcare are the top themes. And these themes tend to be similar, but you've always got one or two. For example, like energy transition was an like interesting theme a year ago. So there are some tweaks that we make year over year as well.
I can imagine you can go to WWF networking or TNC networking and learn about these issues in depth, but is the way that you're approaching it like this is the challenge, but here are the opportunities to then deploy great partnerships from there?
So we're a very practical bottom-up type of approach style group. And we would only basically, because we see the flow coming through, a lot of what we frame it with is couch upon what are the opportunities. And within the opportunities, we tend to focus on those that we think there's a gap or there's additionality.
Well, and I was going to ask, because you've been in this for a long time, so what are the gaps that you still see in the system? Like, what are the gaps that you're trying to fill, and how are you approaching that a little bit differently than the other groups?
I think for us, the gap in the capital gap comes from a little bit philosophically is if there's a will, there's a way. So ultimately, it's about curating a set and building community around a trusted group of private asset owners that want to deploy. So we spend a lot of time of curating that community, equipping them with the right knowledge and the opportunity. And so that's the gap we fill. Because I think a lot of groups focus on many different demographics, let's just say. So not just the private asset owners, but the corporates, the institutional. That's number one. There are other groups that, okay, they're also focused on families and next gen around impact investing. There are a couple of groups out there. For us, within that pocket, we then focus quite a lot on the investable opportunities. So the project curation, the deal flow is kind of what we're quite focused around.
I'm a little bit more critical. I think that we just haven't really maximized or even come close to the potential of the talk that I've heard from family offices. And I'm curious, like, what are the gaps that you still see or the barriers to actually creating the flywheel effect? Because there's a lot of money to be unleashed. What's holding it back in your view?
There are lots of barriers. I think one is the intergenerational conversation that needs to happen. So that's one barrier. And to that type of barrier, what we could do is equip families with more information on both ends, on both perspectives around how they can come together around new approaches to investing, more cases, what other families are doing, return profiles of existing investment, policies, and also working with the next gen in terms of these are some ways that we've seen other next gen work it through the family, through carve outs, or meeting in the middle. That's one critical pathway. In terms of data and research, I think we're still not capturing actually how much is being deployed. These information is often quite, I guess it's like fragmented, confidential, it's sitting everywhere. So a solid piece of research that can truly unearth the data around how much our family offices putting into, rather than, the aspirational or just, very superficial, would be a very interesting piece. And then last is the peer-to-peer case studies, which we know that groups are already coming through and doing that already.
Okay. And actually, I'd kind of extend that conversation for the second gen, like they're coming in. How can they use this platform of, say, impact, blended, shifting the family's investments towards more climate or issue friendly? How can they use that as their entry point into running the family's businesses, running the family's assets?
I think NextGen can really add value if they can pick certain sectors or technologies to focus on and become a bit of an expert or know a bit more and bring that value in the terms of knowledge and sharing back to the family business. That's one. Second of all, some take a different approach. If the family's in real estate, and all the eggs are in that basket, they might build a separate expertise that is completely different to diversify away from the concentrated family risk. So I think we've seen both approaches work. And it also, I think, boils down to personal interests and conviction as well. I think the last part, though, is which we've heard as well. If we know that the next gen and ultimately, I think the current generation also want the next gen to live a fulfilled life, bring value back to the family, it is actually a topic that could become quite a fresh topic to bring the family together if couched in the right way. So that's also a way where we see next gen play a role around these are our values. This is what the legacy is. This is what sustainability can give us a fresh kind of perspective and injection to continue that.
Now, when they're coming back to the family with all these ideas, are there some good tactics or approaches for leading to a higher level of success? I can imagine like the next gen coming in like, we've got to save the world. And the first gen is like, look, guys, we just got to produce more widgets. We got to build more buildings. Like how is that gap getting easier to fix? And are there some tools or tactics or approaches that you found work well when you have that raving environmentalist that wants to go back and get their family business to reorient?
Yeah, I think I don't have one straightforward answer. I think we're starting to collect all these tips with different next gen that we're sort of close with. But generally, I would say it's oftentimes harder if you're doing the other opposite extreme of like save the world. It feels like you're rocking the boat, or you're gonna take a whole load of risk. And it's about how do you meet in the middle. So in the investment context, if you love risky ventures, meet in the middle and maybe start with doing something that's lower risk, right? Can we look into some public equities, or instead of a single deal, let's look at a fund? So you've got to start where it's not threatening. And you're also like bringing the family along where they can learn together. So you're not doing it as a lone ship. It's about the actions you take. You're bringing along the company, you bring along the family. So you're all in it together and learning together.
What advice would you then give to someone who's trying to reorient their family office towards impact? Like, how should they approach that if they're in the beginning phases? They're coming to your workshop to try and work that out. Like, what's the advice you give, like some starting points for establishing or reorienting an existing family office?
I would start by plugging yourself into the community and the networks, because there's a lot of work that's already done. There's actually peers that have already done it. So plug yourself in so that you're open to a lot of knowledge and case points and people that can help you. Or if you need a case, so join an association for that sort of starting point, and then the rest will follow.